there's going to be a lot of pressure for venture investors to put the money to work. But right now, what you're seeing is a lot of make-believe going on in the stock markets. To think about what the incentives are, as Charlie Munger says, show me the incentive and I'll show you the outcome. I posted it into our group chat. Credit Suisse sent all their private banking customers an offer. They are now offering 6.5% for a 3-month T-bill. 6.5%. And if you go back to what we talked about before, when the risk-free rate is somewhere north of 5 or 5.5%, and banks are willing to give you 6.5% in the short term, you have to generate more than 3 times that to make an investment make sense when you're investing in the long term. So if 3-month money is going to pay you 6.5 or 7, if you're going to invest for 10, 15 years, which is what you need to do typically for a startup, you need to get 20 to 25%. So there's going to be a lot of pressure for venture investors to put the money to work, because otherwise their LPs, their limited partners, the people that give them the money, will have this attitude that goes somewhere along the following lines. Okay, I've committed to you. Why aren't you investing? Because otherwise I can get paid 6.5% on the front end. And so this is becoming very problematic. What am I paying you for? What am I paying you 2% a year in management fee for? So I think what happens, unfortunately, is the opposite of what Doug says. I think good investors will try to follow Doug's feedback and advice. And the ones that have a track record of distributions of DPI can do more of it than not. But I think most people will be under pressure to deploy the capital. And so the 500 odd companies, Jason, you mentioned, will get a lot of it and it'll get torched because most of them probably won't amount to much of anything in the short term. You will create way too much correlation and you will have zero time diversity, which, as we've learned, is a recipe for terrible returns. We haven't given enough time for a logical framework of investing to develop, which also is tied to a logical framework for entrepreneurship to emerge. We're just way, way, way too early. So the thing with all of these language models is that they are grist for the mill. And we talked about this before. If it was a highly proprietary asset, you would have never sold 49% of it to Microsoft for $10 billion because you would assume that it was worth $1 trillion. So it's a huge tell on the part of OpenAI, their deep understanding, and they understand it better than anybody else, that it's a bit of a capped upside. So what is uncapped, I guess, is maybe the better question. Well, if you look at the 1849 gold rush as an example, the people panning for gold, in my opinion, are the people building language models today. They're going to come and they're going to go. But who's going to win? Well, the pick and shovel providers won. Levi Strauss won. So what is the equivalent of that today? I think it's at the silicon layer, because you need to really re-architect how compute will actually work in a world of all of these models. Those folks will get paid. If you look at AMD and NVIDIA, they've been getting paid for years. They continue to get paid. They probably will continue to get paid even more. And so folks that actually take a step into doing something hard and difficult in AI, like custom silicon, could get rewarded. And then there's what I call the white truffles. What are these unique ALBA white truffles? These singular sources of data that, when used in reinforcement learning, make your output just zing. And that's where I think Facebook is an obvious white truffle. Quora is a white truffle, but there are a lot of startups that could become white truffles if they gather enough data. And that's like a pretty reasonable framework. And so in that framework, if you apply it to today, there's way few silicon startups and there's way few white truffles. Instead, it's everything is the baloney in the middle, which is random people talking about some random model that's just going to, again, become highly commoditized. You have to remember, all these models are open sourced and none of them mean anything in the absence of the data you give it to train on. For OpenAI, the way that it could become $1 trillion company is actually by cutting the cost to such a low degree that nobody else can effectively compete with it. And then at that point, they can become a small tax. You'd rather just pay it than try to compete with it. And I think for OpenAI, that's actually a very brilliant strategy. So that's how they could get to become very, very large in valuation would be to become so pervasively relied upon, and where they take such a minuscule take rate of their participation in you building a company, that could be really effective.
The cram down, Chamath, that's a bitter pill to swallow. Why would founders do this cram down instead of just adding a little more to the top? And is there a way to do this without, going scorched earth or poisoning the well, as it were? Again, putting this app and Sequoia aside, this is happening all over the ecosystem. So is there a way to do this gracefully, or is it just going to be messy?
I think it's going to be really messy. I mean, to state the obvious, no venture capital investor ever quits the board voluntarily of a great company that's doing well. That would be dumb. So, as David said, sort of like the proof is in the pudding there. And at the same time, there are a lot of companies who don't want to see the writing on the wall and will do all kinds of gymnastics to try to stick a landing on a contorted financing. And sometimes those things have real consequences to other investors who just don't think it's the right thing to do. I wouldn't read too much into this, except that good founders have a responsibility to do what's right for themselves and their employees. Nobody else. And the thing to keep in mind...
Not the investors, really?
No, I think you absolutely have to prioritize the people doing the actual work. And if you actually did prioritize them, what you would probably say to yourself is, oh my gosh, there are people who I work with, who I look in the eye every day. Because investors you'll see once a quarter. But I have my fellow employees as a founder, that I look in the eyes every day, who've been toiling with me for umpteen hours a day, every day for years. And they are now totally underwater. What is the right thing to do for them? And I think if you just answer that question, you wouldn't do all these contorted things. You would just reset the valuation. You would refresh the equity pool. You would issue options back out to those employees, and you would move on. It's all these other things that get in the way of answering that simple question.
Chamath, do you have any macro thoughts here? At the same time this is happening, we saw rents broke in the last month. So rents got cheaper. Yeah.
My governing principle, I think I probably said it too many times, but I'll say it again. Rates are going to be higher than we like, and they'll stay here longer than we want. So if you use that as a principle, whenever the consensus thinks we're done, it's been pretty profitable to be on the other side of consensus. And so I still kind of maintain that we're probably going to have a 5.5% Fed funds rate, which means that, I don't know, maybe Credit Suisse will offer me 7.5% soon on 3-month T-bills, but we're going to have higher rates. And I do think Brad's right, though, in the sense that as long as we know that then that's it, and we can forecast it into the future without it changing too much, it'll be okay. But right now, what you're seeing is a lot of make-believe going on in the stock markets. So this is something that I saw on Bloomberg, which I thought was really interesting. And if you focus on the period of 2020 to 2024, what you see is the white line, which is net income adjusted for depreciation and amortization. And the blue line is cash flows from operations. So what does that mean?
And this is for S&P 500 firms.
This is the best 500 companies in the world.
Yeah.
And the white line is what you tell Wall Street in terms of what you make on paper. The blue line is what actually appears in the bank account. So why could there be a gap between what you tell somebody you made, I made $1, versus what's in the bank, 50 cents? Well, the reason is that there's all kinds of accounting tricks that you can use, accruals, inventories, and all of these things allow you to present a healthier earnings report than is actually true. And so right now, we have the worst earnings situation, so the worst gap between what we are telling people versus what is actually in the bank account that we've had for 30 years, since 1990. And so it just brings into focus the fact that we may be in the last few innings of trying to make sure this all looks okay, in which case, one faction of the investing world who thinks that this earnings recession is actually at hand would be kind of right. And then what they would say is that once we all realize that these earnings are fake and you reset down 15%, that's where you get to the mid 3,000 in the S&P 500. Right now, it's around 4,000. I don't know if that's true or not, but there's more and more evidence that would support that the way that they see the world could be credible. The other side says, hey, listen, this is a bump in the road. We're getting a handle on things and it's stabilizing. So even though it's higher than we'd like, it's not going to change that much. So now just think about 10, 15 years from now and let's go. And those are the folks that want to rip the money into growth stocks and tech stocks again.
How does the consumer play into all this? Record low unemployment, like it's 1% in Utah, 3.5% for the country, 2.5 jobs for every American who's unemployed. And then these rents coming down, but consumers have seemed to have burned off all that extra money they had. So Brad, when you look at the consumer-driven economy that the world lives in.
That's not true because you have to understand, stimulus is still entering the economy. It's just harder to measure. So for example, take Social Security. You have cost of living adjustments in Social Security that's lifting payments by 10 and 15% because it's backdated for what was going on last year. And remember last year, we had 2, 3, 4, 5% inflation rates. So there is more and more money coming into people's pockets that we don't realize. And we're all on the hook for that as US taxpayers. So I think it's very dangerous to kind of look at one data point and try to pick off what's happening in consumer land because there's all kinds of hidden ways in which money gets back to people.